Hey everyone, ready for a deep dive into building a dividend portfolio that just churns out cash?
Sounds like a plan.
Today we're looking at the idea of the monster dividend portfolio.
Oh yeah, I've heard that term thrown around.
It was coined by the financial YouTuber Joseph Carlson, and we're going to be breaking down his video titled, How to Build a Monster Dividend Portfolio.
Interesting. I'm curious to hear his take on it.
Me too. Especially since he claims to have used this strategy to build a portfolio that's currently making him over $21,000 per year in dividends.
Whoa. Okay, now I'm really paying attention.
Right. And the coolest part is that the amount he's making is constantly growing.
That's the beauty of dividends, right? That steady stream of income that ideally just keeps increasing over time.
Exactly. So let's jump into Carlson's strategy. He outlines 3 core principles for building this monster portfolio.
All right, lay 'em on me.
First, you got to buy companies that pay dividends.
That makes sense. It's kind of like the foundation, right? You need that cash flow coming in to get the ball rolling. Exactly. Then you reinvest those dividends.
So use that money to buy more dividend-paying companies. It's like a snowball effect.
You got it. And the final principle is focusing on companies that grow their dividends over time.
Not just any dividend payers, but the ones that are consistently increasing their payouts. Ideally, faster than inflation is eating away at your purchasing power, right?
That's the idea. It's about finding those companies that are committed to sharing their profits with investors and rewarding them for sticking around.
Smart. And it reminds me of that famous Warren Buffett quote about compounding. You know, the one where he compares it to a snowball rolling down a hill. It starts small, but picks up momentum over time.
It's a classic analogy. It's all about letting that compounding magic work its wonders. But here's the thing. Even with the right ingredients and a solid recipe, baking a cake can still go wrong.
Oh. You're telling me there are common pitfalls even with a dividend growth strategy?
Unfortunately, yes. And Carlson highlights some of the biggest mistakes that dividend investors make.
I bet I've made a few of these myself.
Probably all of us have at some point. So let's learn from others' mistakes and see if we can avoid making them ourselves.
Sounds like a plan. What's the first one on the list?
Well, it's the allure of those high starting yields.
Oh yeah, those can be tempting. I mean, who doesn't love seeing a big, juicy dividend yield?
It's like a siren song, isn't it?
Definitely. Companies like Verizon and AT&T, they dangle those tempting yields in front of you.
And it's easy to get caught up in the excitement. I've definitely been there, thinking I'm getting this amazing deal.
But there's a catch, right?
There often is. Those high yields can sometimes be a red flag, like a warning sign that something might not be quite right.
So it's not as simple as just chasing the highest yield.
Not necessarily. Carlson calls these value traps.
Value traps. Okay, I need to hear more about this.
So sometimes a company might have a high yield because its stock price has fallen significantly.
And that could be because the company's facing some challenges.
Exactly. They might be struggling to maintain their earnings, or their business model might be under threat.
So that high yield could actually be a sign that the dividend is unsustainable.
And it could be cut in the future, leading to a loss in both your income and your principal.
Ouch. That's not a good scenario. So how do we avoid falling into these value traps?
It takes some digging. You have to look beyond the yield and really analyze the company's financials.
Like a financial detective.
Precisely. Look at things like revenue growth, free cash flow, earnings per share, debt levels.
These are all clues to a company's financial health.
Right. It's about understanding whether that dividend is truly sustainable, whether the company can afford to keep paying it, and ideally grow it over time.
It's about separating the genuinely good dividend payers from those that might be flashing a warning sign.
Exactly. So it's not always about the biggest yield. Sometimes a lower starting yield can actually be a better long-term investment.
Especially if the company is growing and increasing its dividend over time.
Right. Think of companies like Texas Roadhouse or MasterCard. They might not have those eye-popping yields initially, but they have a history of consistent dividend growth, and their stock prices have also appreciated nicely.
That's where the real compounding magic happens. You get both the increasing income stream and the potential for capital gains as the stock price goes up.
Okay, so we've dodged the high-yield trap. But what's next on the list of common dividend investing mistakes?
I'm all ears. Tell me more. Well, the next mistake Carlson warns against is over-diversification.
Over-diversification. So you're saying there's such a thing as having too much diversification.
I'm sorry. I mean, don't get me wrong, diversification is important. It spreads out your risk, right?
Yeah, not putting all your eggs in one basket.
Exactly. But Carlson argues that there's a point where the benefits of diversification start to plateau.
Oh, interesting. So more isn't always better.
Right. Research suggests that after you have about 7 to 10 different companies in your portfolio, the risk reduction benefits start to level off.
I hadn't thought about it that way. I guess it makes sense. There's only so much you can diversify away.
Exactly. And going beyond that, having dozens or even hundreds of stocks can actually make things more complicated.
Yeah, I can see that. You're spreading yourself too thin, right?
Yeah. And you might not have the time or energy to really understand each of your holdings. Carlson himself favors a more focused approach, with a portfolio of just 10 core holdings.
10. So it's about quality over quantity.
Exactly. It allows him to really dive deep into each company, understand their business, track their performance closely.
It's like having a small team of all-stars rather than a huge roster of mediocre players.
Exactly. All right, ready for the final mistake that Carlson highlights?
Hit me with her.
Investing in what Carlson calls bad industries.
Oh, bad industries. That sounds intriguing. Tell me more.
Well, it's important to note, this is Carlson's opinion, but I think it's an opinion worth considering. He learned this the hard way through a past investment in Boeing. He invested in them and then realized that these complex, capital-intensive industries, they can be tough to navigate as an investor.
I can see that.
Yeah.
So much can impact their performance, things that are really hard to predict.
Exactly. And he draws parallels to other industries that have faced similar headwinds in recent years, like companies like Intel and 3M. They've struggled with intense competition and keeping up with innovation.
So if these are bad industries, what does Carlson consider a good industry?
He suggests looking for companies that operate in industries where, as he puts it, everyone's winning.
Everyone's winning.
Okay?
What does that look like?
Well, think about companies with simple, predictable business models, companies with strong competitive advantages. Companies like SP Global, Microsoft, Costco. These kinds of companies operate in industries with pretty consistent demand, and they have a history of delivering solid returns.
Okay, so it's about focusing on quality businesses, not just chasing yield in potentially risky or volatile sectors.
Exactly. It's about aligning yourself with companies that have that long-term potential for growth and stability.
It's about taking a more holistic view, not just looking at the numbers in isolation.
You got it. And speaking of companies with potential for long-term growth, we got to talk about what Mark Zuckerberg is up to over at Meta.
Oh, yeah. Zuck's always up to something, isn't he? What's the latest?
Well, it seems like he's got Twitter in his sights. They're working on this standalone app that's meant to rival Twitter.
Whoa, seriously, I hadn't heard about this. What's the app called?
Well, it's currently codenamed Project 92, not the most catchy name. But the interesting part is that it sounds like they're planning to use Instagram's giant user base to jumpstart the app's adoption.
Ah, clever. Leverage that existing network? It's a classic Meta move, isn't it? They're always borrowing ideas and features from competitors. But this feels a little different, though, doesn't it? Like, more aggressive.
It does. I mean, they've integrated features from other apps before, but this is like launching a whole new platform specifically to take on a competitor.
It makes you wonder what's motivating Zuck here. I mean, there's obviously the competitive drive.
Oh, for sure.
But you have to wonder if the changes at Twitter under Elon Musk have added fuel to the fire.
Yeah, maybe there's a sense of opportunity there. Like maybe Zuck sees this as a chance to capitalize on some of the uncertainty and shakeups happening over at Twitter.
It's a bold move, that's for sure. And then you have to factor in the whole Apple situation.
Oh, yeah. The elephant in the room.
Apple's App Store policies and those privacy changes, they've had a huge impact on Meta's business. You have to think that's got to be playing a role in Zuck's thinking here.
Absolutely. He's been pretty vocal about his issues with Apple's control over the app ecosystem. And this move, launching a Twitter competitor, could be seen as a way to work around some of those restrictions.
It's almost like a power play, a way to try and reclaim some control and reduce their reliance on Apple.
Exactly.
Yeah.
It'll be really interesting to see how this plays out. If this new app gains traction, it could really reshape the whole social media landscape.
And maybe even shift the balance of power between Meta and Apple.
We'll definitely have to keep an eye on this one.
Speaking of Zuck and Apple, did you see his reaction to the launch of Apple's Vision Pro headset?
Yeah, that was interesting. He was kind of praising them, but also throwing some shade at the same time. A classic Zuck move.
It was like a masterclass in passive-aggressive commentary.
Right. He was like, oh, great to see Apple entering the VRR market. It really validates the category.
But then in the next breath, he's pointing out the Vision Pro's crazy high price tag, $3,500.
And subtly contrasting it with Meta's more affordable offerings is very strategic.
It felt like he was trying to position Meta as the leader in the social VRR space.
Definitely. But are his arguments valid? Let's break them down a bit.
Okay, let's do it.
So first, the validation claim. Remember when the CEOs of Peloton and Zoom said similar things when Apple entered their markets?
Yeah, they were all like, this is great for the industry. It shows that we're on the right track.
And how did that turn out for them?
Not great, right? I think both of them ended up facing increased competition from Apple, and their stock prices took a hit.
Exactly. So Apple entering a market doesn't always mean good things for the existing players. Then you've got the price argument.
Yeah, Zuck was emphasizing affordability, but Apple has a huge advantage though, don't they?
Oh, yeah. They have a massive existing customer base, over 2 billion devices out there. So price might not be as big of a barrier for them as Zuck might hope.
And Apple fans are known for their willingness to pay a premium for their products.
That's true. Plus, Zuck also tried to frame Meta's headsets as more social and Apple's as isolating.
But wasn't Apple's presentation all about showing off the social aspects of the Vision Pro?
Right. They showed how you can use it to connect with people, attend events, and all sorts of social stuff.
And app developers are probably going to jump at the chance to create even more social experiences for the Vision Pro.
Totally. So I'm not buying Zuck's argument that Apple's headset is inherently antisocial.
I'm with you. Apple has a history of dominating new device categories. Tablets, phones, laptops, and I don't see why headsets would be any different.
It's going to be an interesting battle to watch, that's for sure.
All right, well, before we get too lost in the metaverse, let's come back down to earth for a minute. Remember that TikToker with the wild house hacking advice?
Oh, yeah. The kidney guy. What was his plan again?
Okay, so you ready for this? This was his plan. Sell a kidney on the black market for $250,000.
Whoa, hold on. What?
That's just the start. He'd then use the money as a down payment on $1 million house.
Okay, so far so. Illegal and unethical.
Exactly. But wait, it gets even weirder. He then rents out the house for 3 years to make back the money.
All right. I guess that part makes sense from a purely financial standpoint, but it still doesn't justify,
I know, right? But here's the kicker. After 3 years, once he's made back the money, he buys back the kidney and has it reinserted.
Wait, hold up. Buy back the kidney.
Nope, that was his actual advice. Like it's some kind of casual transaction.
I can't believe we're even talking about this. It's so absurd, so outrageous, not to mention medically and ethically just wrong.
It's like a bad joke. And a reminder that not all financial advice, especially stuff you see on social media, is good advice.
It's a great example of how important it is to be skeptical and do your research before you take any financial advice to heart, especially when it involves major surgery and the black market.
Couldn't agree more. So please, folks, no matter how tempting it might seem, don't go selling your organs for a down payment on a house. There are better ways to reach your financial goals.
Much better ways. And on that note, let's get back to the topic of building a solid dividend portfolio the right way.
Okay, so I think we've covered a lot of ground here. Let's do a quick recap of what we've learned from Joseph Carlson about building that monster dividend portfolio.
Sounds good to me. Always good to summarize the key takeaways.
So those 3 core principles he laid out, they're really the foundation.
Definitely. Buy companies that pay dividends, reinvest those dividends, and focus on companies that grow their dividends over time. It's a simple but powerful framework.
And then all the stuff about avoiding those common mistakes, like chasing those high starting yields, over-diversifying and investing in the wrong industries. That's gold.
It's like he's giving us the cheat codes to successful dividend investing.
Right, like he's sharing all the lessons he learned the hard way so we don't have to.
Exactly. And those lessons aren't just for beginners either. Even seasoned investors can benefit from a reminder now and then.
So basically, we want to find those companies that are paying growing dividends, not just high yields, but dividends that are consistently increasing.
Right, and we want diversification, but not too much diversification. We need to make sure we can really understand the companies we're investing in.
And we have to be mindful of the industries we're investing in. You know, like Carlson said, those industries where everyone's winning.
Those companies that have simple, predictable business models.
Yeah.
The ones that have carved out a nice competitive advantage for themselves.
And ultimately, it's about finding those companies that you believe in for the long haul, right?
Totally. It's not about trying to time the market or jump on the latest hot stock.
It's about finding those quality businesses that align with your investment strategy.
And then having the patience to let them grow and compound over time. That's the key to long-term success with dividend investing.
It's about building that portfolio that throws off passive income year after year.
That's the dream, right? A steady and growing stream of dividends that can help fund your lifestyle or reinvest for even more growth.
Now, Carlson lays out a great roadmap, but the world of investing, it's constantly changing.
Oh, for sure.
Hmm.
And I think that's an important point to remember. Just because a strategy works today doesn't mean it's guaranteed to work forever.
Right. New industries pop up all the time. Technology is disrupting those traditional business models. Things are always in flux.
So how do we adapt to that? How do we make sure our dividend portfolio stays relevant as the world changes around us?
That's the million-dollar question, isn't it? I mean, think about it. The companies that were the dividend all-stars a couple decades ago, a lot of them aren't even around anymore.
Or they've been replaced by younger, more innovative companies.
Exactly. So as we build our portfolios, we have to think about not just the present, but also the future.
Right. What new industries, new business models are going to emerge?
What trends are we seeing now that might provide those exciting dividend opportunities down the road?
Yeah, and as investors, what skills do we need to develop to stay ahead of the curve?
It's like we have to become futurists as well as investors.
Absolutely. Building a successful dividend portfolio isn't a set it and forget it kind of thing. It requires us to constantly be learning, adapting, and making those informed decisions.
Well, this has been a fascinating deep dive into Joseph Carlson's approach to building a monster dividend portfolio.
I learned a ton. Hopefully our listeners did too.
I think he's provided us with a really solid framework to get started, but it's up to each of us to take those principles and apply them thoughtfully.
And adapt them to our own individual circumstances and goals, of course.
And to remember that the world is constantly changing, so we have to be willing to adapt along with it.
Exactly. Well, I think that about wraps it up for this deep dive.
I think so too. And until next time, remember, knowledge is power.
Especially when it comes to building your financial future.
Happy investing, everyone!